Hi, in this session we'll be learning one new accounting principle and quickly we will cover up all the other principles that we have come across in our previous sessions. Well, there's one question in the minds of many new accountancy learners, just like my friend Peter's, and that is there a specified duration or dates according to which you must maintain your accounting reports? Now, a business is ongoing and continuous. It is not practical to wait forever to balance accounting books, meaning to collate or finalize these accounting statements. If we did that, we would not be able to calculate the current profit and loss and know the overall status of assets and liabilities at any particular point of time. Hence, we need to close books of accounts at some specific date or interval that could be yearly, quarterly, or even at monthly basis. When I say the word close, it means we do a cutoff of accounting transactions at a particular date. So we choose a defined beginning and an end of a period. Let's say Jan 1st to December 31st, or April 1st to March 31st, or June 1st to September 30th, and so on. So in this closing process, what is actually done is all the balances of each account during this period are posted to a statement called as the trial balance, and then adjustment entries are made, and finally these amounts are posted to the final statements of accounts, which then states the profit or loss of the business. This process helps us to arrive at results of our business activity during this particular period. Therefore, in order to report the periodical progress of a business, this concept of periodicity is developed, which assumes that indefinite life of a business is divided into parts, and each of these parts is called as an accounting period. An accounting period is generally of 12 months, but they are different in different countries and for different businesses. Most of the times, organizations choose to go with the statutory prescribed period in their country, which is also called as a fiscal period, because they need to consider that period for tax and statutory purposes. Statutory meaning legal. Many other businesses like to keep different accounting period due to business-specific reasons. The principle of accounting period helps a business in so many different ways, that is to analyze the performance of business, to compare their reports of any of their previous accounting periods. It helps a business to distribute their income at regular intervals, to calculate tax. It also helps banks and other financial institutions and creditors to know what is the position of this business and so on. So this was the accounting period concept. I hope my friend Peter has the answer to his question now. So we have come to an end of all the 10 different principles in this session. I hope you're finding this easy to understand. The concepts will get more clear to you as and when we start recording and when we do the actual accounting. We'll be doing a little exercise now based on all the different accounting principles that we've covered so far. Let's begin. Feelings such as sorrow, anger, love, and happiness cannot be recorded in accounting books under this concept. Money measurement concept, which states only events that can be valued in terms of money can be recorded in accounting books. The basic idea of this concept is that business is separate from its owners. Which concept? The business entity concept. Next, under which concept income and expenses are recorded when they are due or they occur? That's right, accrual concept. This concept assumes that the business has a very long life. Which concept? The going concern concept. The concept which states every transaction should have two equal effects, the dual aspect concept. If the market price of a laptop is $800 but the owner bought it on a special sale for $500, at what price will he record the purchase according to the cost concept? $500, as the concept states that transactions should be recorded on cost price and not on the market price. Under the matching concept, the expenses is matched to the period of its related revenues or services. As per this concept, every transaction must be supported by a documentary evidence. Concept of objective evidence. According to this principle, the income is said to be realized when it is received or it is earned. The revenue recognition or the realization concept. And the last one, in order to report the periodical progress of a business, it is assumed that indefinite life of a business is divided into parts called as accounting period. So this is all for today. If you like the video, please go ahead and give this a thumbs up. And we would love to receive your feedback, so leave in your comments below. And don't forget to subscribe to our channel. Keep watching, keep learning.